Welcome to Breaking News to Trading Moves. Today we're looking at a key decision out of China, one that didn't make waves with a change, but actually by not changing.
That's right. We're talking about the loan prime rate, the LPR. China decided to keep it steady. This came right after the U.S. Fed actually cut rates, so there was quite a bit of chatter, maybe expectation, that China might ease things up too.
But they held firm, so the numbers didn't budge. The one-year LPR is still 3.0%, and maybe more critically for some sectors, the five-year LPR stays at 3.5%.
Exactly. And that stability or lack of easing creates some pretty distinct outcomes.
So our mission for you listening is to get a handle on why they might have held steady, and importantly, who ends up ahead because of this and who's, well, left wanting.
Okay, let's start with the winners. And the most obvious group here is the financial sector, particularly the big established banks.
Why is stability good for them? You often hear about needing lower rates to stimulate lending.
Well, it's about their margins, specifically their net interest margins, or NIMs. When the LPR doesn't get cut, it means less immediate pressure on those NIMs.
NIM compression. We hear that term a lot. So holding the rate prevents that squeeze.
Pretty much, yeah. See, if the LPR drops, banks have to lower the rates on many of their existing loans quite quickly. But the interest they pay out on deposits, their funding cost, that might not fall as fast. So boom, their margin gets squeezed.
Okay, makes sense.
By keeping the LPR steady, the central bank basically avoids adding more pressure right now. It helps preserve bank profitability, which is pretty crucial when they're already managing existing credit risks.
So which banks are we talking about here?
Think the giants. Industrial and Commercial Bank of China, that's IDCBY, they definitely benefit from that NIM stability. Plus, there's a side benefit.
Oh, what's that?
With the Fed cutting and China holding steady, the difference, the yield gap between U.S. and Chinese interest rates gets smaller. That tends to support the yuan, makes it a bit more stable, which helps with funding.
Right, less incentive for capital to flow out if the yield difference isn't as large.
Exactly, so it's a double win for them.
Yeah.
Better margins at home and a more stable currency situation. We see a similar story for China Construction Bank, CICHY.
They also benefit from stable spreads.
Yes, stable benchmark rates help protect their spread income, reduces the risk of further NIM compression, especially when credit growth is already a bit cautious.
And Bank of China, ticker BACHY.
Same logic applies. Unchanged mortgage and corporate loan benchmarks mean less downside risk to their asset yields. And like the others, a steadier yuan is good news. It reduces foreign exchange volatility on their balance sheet, which is significant for them given their international presence.
So a clear strategic choice here, it seems, prioritizing the health of the major banks.
It certainly looks that way.
Okay, let's shift gears slightly. Are there winners outside the pure financial space? You mentioned airlines earlier.
Yes, airlines are interesting beneficiaries here, not because of NIMs, obviously, but because of their costs, specifically costs in U.S. dollars.
Fuel and planes.
Exactly. Airlines have huge expenses denominated in USD. Fuel is a big one, aircraft leases, maintenance contracts. A lot of it is priced in dollars.
So if that narrower rate difference helps stabilize or even strengthen the yuan against the dollar,
then those big USD costs become cheaper for them in yuan terms. It directly helps their operating results.
Makes sense. So like China, Eastern Airlines, CHNEY.
Yep. For them, any easing of those USD fuel and lease costs is a welcome relief. And on top of that, stable domestic interest rates mean their own debt servicing costs remain predictable. That's really important when you're managing such large liabilities.
And presumably the same for China Southern Airlines, ticker CHKEF.
Similar picture. Currency stability, liability stability, it improves their cost visibility, especially for international routes. Predictability is key in that business.
It's fascinating, isn't it? A decision that signals maybe slower overall growth holding rates steady actually helps these specific sectors because of their unique vulnerabilities.
It highlights the trade-offs policymakers are constantly juggling. They protected bank margins and helped manage FX risk for airlines, even if it meant less broad stimulus.
Which brings us neatly to the other side of the coin. The sectors that were probably quite disappointed by this lack of action. Let's talk losers, starting with property.
Yes, this is where the lack of a cut really hits home, especially the fact that the five-year LPR didn't move from 3.5%.
Because that's the benchmark for mortgages, right?
Precisely. It's the key rate for mortgages, both new and existing ones with floating rates. Developers and potential home buyers, too, were really hoping for a reduction there. Even a small one could have helped lower monthly payments, maybe sparked a bit more
Just
activity.
holding the line sends a different message.
It suggests that any support for the property market needs to come from, more targeted local policies, not a big nationwide rate cut that would squeeze the banks further. That's how the market reads it.
And the impact on developers. Many are already struggling.
It means the pressure stays on. For developers like China Vanke, CHVKY, the lack of mortgage rate relief means affordability remains tight for buyers. Sales don't get that needed boost, and that extends the liquidity stress they're under.
So it makes it harder to generate cash flow from sales.
Definitely. And it also impacts refinancing for companies like Longfor Group, LGFRY. Without that signal of lower rates, refinancing existing debt remains challenging, keeping the pressure high on their cash flows.
And for a player like China Overseas Land and Investment, TCAOVY.
Same basic problem. A steady LPR doesn't provide any new policy tailwind for mortgage demand or for stabilizing property prices. That weighs on how quickly they can sell units in their projects, and it hits their margins. They needed a bit of help from rates, and it didn't come.
A tough situation for that entire sector then. It's not just property feeling the pinch, though, is it? What about big-ticket consumer items like EVs?
Good point. Electric vehicles are another area sensitive to this. While car loans aren't mortgages, they are often benchmarked against the LTR. So no rate cut means no fresh incentive from cheaper finance.
And these are expensive purchases, sensitive to confidence and credit costs.
Extremely sensitive. For companies like NIO, ticker NIO, stable rather than falling, loan rates don't help stimulate demand. When consumers are maybe already a bit cautious, the cost of borrowing matters a lot for these big purchases.
So no tailwind for sales volumes.
Right. And we see similar issues for XPeng, that's 6PEV. Without cheaper financing becoming available, it's just harder to accelerate sales growth. It also sort of contributes to a general cautiousness among investors towards some of these China growth stocks because the demand picture looks constrained by credit costs.
Okay, so let's try and wrap this up. The decision to hold the LPR steady seems to have drawn a clear line.
It really has. On one side, you have the winners, the big established banks, benefiting from protected margins and airlines helped by currency stability relative to their USD costs.
And on the other side, the losers. The property developers and EV makers, sectors that rely more heavily on cheaper credit to stimulate demand and activity, and they didn't get that boost.
Yeah, it paints a picture of policy priorities right now. It seems preserving the stability of the core financial system, the bank's margins, took precedence over providing broad stimulus for consumption or the housing market.
Which leaves us with a final thought for you, the listener, to maybe mull over. This focus on bank stability today, is it sustainable long-term if sectors like property remain under pressure?
That's the key question, isn't it? If prioritizing bank health now leads to prolonged weakness in a critical area like real estate, could that eventually feed back and create, different kinds of risks down the line? It's a delicate balancing act.
Indeed.
And just a reminder for everyone listening, this discussion is purely for informational purposes based on the materials reviewed. It's not financial advice, and it's certainly not a recommendation to buy or sell any securities mentioned. It's just our analysis.
Absolutely. Thanks for joining us for this look at market moves and the thinking behind them. We'll catch you next time on Breaking News to Trading Moves.